Right, so hello all. I'm Shlomo Cooper, and this is Thursday. That means our weekly webinar. Hopefully you can see right now the presentation right now, IPOs Born for Success. And the term initial public offering, IPO, actually slipped into everyday speech during, I think, the tech bull market of the late 1990s. And back then it seemed you couldn't go a day without hearing about a dozen new dot-com millionaires in Silicon Valley who were cashing in on the latest IPO. So the phenomena actually spawned the term Siliconaire. Siliconaire is a combination between Silicon Valley and a millionaire, and that described the dot-com enterprises usually in the early 20s or 30s who suddenly found themselves living large on the proceeds from their internet companies' IPOs. So what is an IPO at all, and why it's very, very interesting for us, IPO? And how did everybody get so rich so fast? And most importantly, is it possible for traders like us to get in on an IPO? And why I claim that IPOs are like golden coins on the floor of Wall Street, waiting for us to be collected. So we are going to deal today with these questions. We're going also to learn a very special and profitable technique I learned in Wall Street. Actually, I was raised and I was educated in Wall Street, and all the strategies I'm bringing to you in this trading room and in these webinars are part of them, at least, are tools that I got, that I learned while I was trading in Wall Street. So I'll show you tools that I'm using in today's market every day in order to capitalize on very, very large gains from these special events in Wall Street. Actually, we are going to divide this webinar into two. This is going to be the first webinar, and the second webinar we are going to continue this the second part of this webinar next week on Thursday. And I have to tell you that I'm very, very passionate about IPOs because it reflects the spirit of invention and innovation of the enterprises who launched the IPO. Usually, we are dealing here with new companies developing groundbreaking products and services that transform industries and change people's lives. Think of Apple, think of Amazon, and think of Google as examples. They were all at one point in the time an IPO, an initial public offering. Today, investors and traders have the opportunity to profit from newly public companies that are experiencing dramatic growth but are not yet well known or understood. And I'm going to show you how to do it both for swing trading and day trading. This is really, really exciting niche in the market. So what is an IPO? IPO is the first sale of stock by a company to the public. This is the definition. A company can raise money by issuing either debt or equity. If the company has never issued equity to the public, it's known as an IPO. Now, companies fall into two broad categories, private and public. A privately held company has fewer shareholders and its owners don't have to disclose much information about the company. Anybody can go out and incorporate a company, just put in some money and file the right legal documents. Most small businesses that we know of are privately held, but large companies can be private too. And did you know that IKEA, Toys R Us, and Hallmark cards are just examples of big companies, large companies that we all know of, and they are all privately held. Now, public companies have thousands of shareholders and are subject to strict rules and regulation. They must have a board of directors. They must report financial information every quarter, as we see in Wall Street. So the next question we have to address is why a company would like to go public. And going public raises cash, and usually a lot of it. Being on a major stock exchange like New York Stock Exchange or the Nasdaq carries a considerable amount of prestige. And in the past, only private companies with very strong fundamentals could qualify for an IPO. It wasn't easy to get listed. And so big publicly traded opens many financial doors if I think about it. First of all, because of the increased inspection, public companies can usually get better rates when they issue debt. So this is a very big advantage for a company to have lower rates on their debt. And as long as there is market demand, a public company can always issue more stock. So thus mergers and acquisitions, what we know as M&A, are easier to do because stock can be issued as part of the deal. And the third thing I can think of about why it's a good thing to be publicly traded is that trading in the open markets means liquidity. This makes it possible to implement things like employee stock ownership plans, which of course help to attract top talents to the company. Let's go and talk about getting in on an IPO. And before taking an IPO or getting in on an IPO, we have to understand all the process of the underwriting. Now, getting a piece of a hot IPO is very difficult, if not impossible, I would say. And to understand why, we need to know how an IPO is done, a process that is known as underwriting. When a company wants to go public, the first thing it does is hire an investment bank. Now, a company could theoretically sell its share on its own, but realistically speaking, an investment bank is required. It's just the way Wall Street works. Underwriting is the process of raising money by either debt or equity. So you can think actually of underwriters as middlemen between companies and the investing public. The biggest underwriters are names that absolutely you heard of, like Goldman Sachs, JP Morgan, Credit Suisse, First Boston, and Morgan Stanley. The company and the investment bank will first meet to negotiate the deal. Items usually discussed include the amount of money a company will raise, the type of securities to be issued, and all of the details in the underwriting agreement. The deal can be structured in a variety of ways. For example, in a firm commitment, the underwriter guarantees that a certain amount will be raised by buying the entire offer and then reselling it to the public. Also, investment banks are hesitant to shoulder all the risk of an offering. So instead, they form a syndicate of underwriters. One underwriter is leading the syndicate and the others sell a part of the issue on their own. Once all the sides agree to a deal, the investment bank puts together a registration statement to be filled with the SEC. And this document contains usually information about the offering as well as the company info such as financial statements, management background, any legal problems that the company may deal with, or where the money is going to be used, and of course the insider holdings. Now, the SEC then requires a cooling off period in which they investigate and make sure all the material information has been disclosed. Once the SEC approves the offering, a date is set when the stock will be offered to the public, and in a couple of minutes I'm going to show you how to know all the information, how to know which stocks are going to be IPOs or are going to be offered to the public in the upcoming days. Now, the underwriter and the company attempt to hype and build up interest for the stock, for the issue. So they go on what we call a roadshow, where the big institutional investors are quoted. As the effective date approaches, the underwriter and company, they all sit down and decide on the price. What is the right price for the stock to be traded? Now, this isn't an easy decision, not at all. It depends on the company. It depends on the success of the roadshow they made. It also, most importantly, it depends on the current market conditions. So pay attention that while the best interest of the company is to get as much money as it can, the best interest of the underwriter on its side is to succeed with the IPO. It wants to have a successful IPO. So it doesn't want to get stuck with all or with part of the stocks. So this idea that the underwriter doesn't want to get stuck with this IPO, with the stocks, he wants to resell it to the public. This idea is very, very fundamental for us. And as you are going to see, it's a key element to our approach when we get to trade IPOs. What about me? What about me? So as you can see, the road to an IPO is a long way. It's a complicated one. You may have noticed that individual investors aren't involved until the very end, and this is because small investors aren't the target market. They don't have the cash, and therefore they hold very, very little interest for the underwriters. If the underwriters think an IPO is going to be successful, they will usually pad the pockets of their favorite institutional clients with shares at the IPO price. So the only way for you to get shares, and just to tell you that the statistics tell us that usually an IPO goes up on the first day 17%. This is the average IPO. So this is why everyone wants to be in an IPO when it happens. And the only way for you to get shares is to have an account with one of the investment banks that is part of the underwriting syndicate. But don't expect to have an account with $1,000. This is not going to shower you with an allocation. You need to be frequently trading client. You must have a large account. And when I'm talking about a large account, that means something with at least $5 or $10 million in your account in order to get your share in an IPO. So bottom line, your chances of getting early shares in an IPO are slim to none. And if you get shares, it's probably because nobody else wants them. So be careful. But it's incorrect actually for me to say it's impossible, but just keep in mind that the probability isn't high if you are a small investor. So we are interested actually, so what an IPO means for us, right? And today we are going to focus on holding, trading, and investing in IPOs from the swing perspective. That means holding them from a couple of days to a couple of weeks. And in the second part of the webinar, which is going to take place Thursday next week, I'm going to discuss in depth how to day trade it. So actually, and let's first of all have a couple of statistics about IPOs. On average, there are $135 billion raised with an IPO. The IPO market is an economically significant investment category, and yet newly public companies are underrepresented in core equity indices and portfolios. These unseasoned equities can be important enterprises that are simply unfamiliar to public investors, but that spells for us opportunity. Let's first of all talk about the potential that that lies below the feet of an IPO. And let's understand the potential of trading an IPO. Every day, new companies are formed, and the most successful ones are able to take their companies public, while only a few IPOs will become household names like Intel, like Google, like Microsoft. Some relatively unknown newly public companies will see startling share appreciation in their early trading days. And let's see a couple of examples. So I bet you all know Apollo, APOL. This is the symbol, Apollo Group. It's from the education sector. Actually, it's running the University of Phoenix in the United States and a couple of other education institutes in the US. And this one, it went with its IPO on 1994, and it rose more than 1,100% in 74 weeks. Or like, let's take a Rackspace hosting, Rackspace hosting, RAX. RAX went public on 2004, and it rose 541% in 156 weeks, or 488% in 46 weeks. Or Intercontinental Exchange, this is ICE, the symbol ICE, went public on 2000. In 2005, it rose more than 340% in only 110 weeks. So because these companies by definition are new, they are not well known, and making these companies even more hidden is that the investment banks that take the companies public by SEC rules are not allowed to issue any research or any recommendation on the company for a period of time after the company goes public. And and also major indexes are slow to include IPOs. Let's think of Facebook, and it took more than 1.5 years for the S&P 500 to include Facebook as one of the components of the index. So this void creates opportunities for those savvy investors, savvy traders that willing and able to do the homework. First of all, there are a couple of ETFs that I want to introduce you. These ETFs track IPOs, and one of my personal favorites is the FXP. And let's just take a look on my chart on FXP. Right, so just look on the daily chart. On the daily chart, right? No, it's not FXP, it's FPX, right? Yeah, all right. So it's FPX. I'm taking here a weekly chart, so we will be able to see the movement of this ETF. FXP seeks investment results that correspond generally to the price and return of an equity index called the IPOX 100 index. I'm going just to write it here in the chat room. This is the index IPOX 100. The IPOX 100 composite index is operating regularly, with IPOs being added to the index at their 7th trading day upon going public, and they automatically exiting from the index after 1,000 trading days, or approximately 4 years thereafter. So let's take a look. So this is just the index. Let's see what how an IPO index look like looking on the FPX, sorry, on the weekly chart. So as we can see, FXP here is around $37, a little bit below $37. 1 year after that, FPX was traded for $45. So that gives us a return of 51% for this ETF in 2013. Or let's take a look on 2014, this year. So if we are going to look on this year, it started around $45. It slided a little bit down, but then recovered, and right now it's trading for $46.11. So that gives us back to the chart. That gives us 14%. Just take into consideration that looking on the SPY, on the weekly chart of the SPY, the S&P 500, if this is the start of the year, is actually trading right now down. Its head is under the water. Actually, it's down about 1.5% from the start of the year. So actually the FPX is posting much higher return from the start of the year. Now, we don't want to trade an index. You can trade an index. I just want to show you how the FPX is trading. But of course, if you have 51% on 1 year, you can actually spot very, very special IPOs that are not going to make you 50% a year. They're going to give you 100% a year. They are going to give you 300% a year, but not a year, in a matter of couple of weeks to couple of months. And I just want to show you how it's being done and how you can do it. So couple of statistics about IPOs, and we will get to the trading technique in a moment. First of all, as we can see here, the amount of IPO pricing. Last year, 2013, they were 222 new IPOs. So that means there are a lot of IPOs. Actually, it was a record year, 2013. We just started the year in 2014, but already we have 31 IPOs, and actually a couple of experts are claiming that this year is going to break the record year of the previous year of 222. All right, now let's see why we should, as investors and traders, look on IPOs from the return point of view. First of all, if we are taking the last 100 IPOs, I took the statistics till yesterday, the 12th of February. So the last 100 IPOs, actually 82 of them, that gives us 82%, went up after the IPO pricing. Only 18% went down, where the percentage change from the issue price is 39% on average. And just bear in mind that you can get much better returns, as I'm going to show you in a minute. By the way, at the same period, the Nasdaq Composite made only 10%. So actually, these IPOs made 4 times the movement of the Nasdaq Composite. If we are going to take just the scorecard of the IPO for this year, for 2014, they were 30 IPOs. 21 of them went up, only 9 went down. This is very, very sound statistics. The total return from the issue price on average is more than 23%, and we are only in the second month of the year. So this is 23% of stock that a part of them just went publicly last week or 2 weeks ago. This is a stunning information for us, and let's make money out of it. So first of all, I want you to see here the potential, and let's take a couple of the stocks and we will go over them, and you'll see how I'm trading it on swing trading. So first of all, I want to see. Let's take one of the we have here all the stocks that went publicly in the last 1 year. Let's take, for example, INSY, INSY. As you can see, the offer date was the 2nd of May 2014. The offer price was $8. Yesterday, it was traded for $53. So that gives us almost 600% over the time of a year. Let's see how INSY is looking on the chart. So I'm putting here INSY. I'm going to use the daily chart. So I'm back to the daily chart, and let's get back to the stock. All right. So watch it with me. This is all right. So yeah, watch it with me. This is the first IPO. All right. This is the first day of the IPO. Now, what I'm going to do, I'm not going to trade it. We are talking from the we are talking right now on the swing technique. I'm not going to trade it on the first day. I'm just going to let the stock go up and go down in the first day. I'm not touching it in the first day. In our next chapter, in our next part of this webinar, we are going to see how we are going to capitalize on huge gains on the first trading day. But right now, let's leave the first trading day for others, and let's focus on what's going on the stock after the first day. I'm going to sketch here a line above the highest point, all right, above the high of the first day. I perceive the first day of the stock as a birth of a new baby to the world. So a new baby comes to the world. Think of it for a moment. It knows nothing about its surroundings. It knows nothing about the world. It has no taste. It has no manners, and it's just start to discover what's going on around him. The same thing for the stock. It has no moving averages. It has no historic prices. It has no trend lines. It has no chart. It has nothing. All right. What it's doing in the first day is just to check the boundaries. It's just to discover the new world that is out there. So this is what the first candle is all about. And if the stock is going to behave like a good IPO, if all the public is going to discover this stock, couple of days, couple of weeks, or couple of months, I don't care. After the IPO, I want to be there first because I want to make the big gain, the big distance. So I'm just going to place a buy order above the high of the first day candle. The minute the stock is going up, all right, I'm in. Usually, what I'm going to do, so this bar got us into this trade. Now, what I'm doing usually is to wait for a $10. My target, my first target is $10, not below it. So actually, I took this trade around $10, and I have a special account for it. I took it around $10, and I just waited. Actually, I'm still waiting for $21. Look here that it got to $19. So it almost doubled in a matter of 1 month. Now let's just see if I got my $20, because if I'll keep scrolling here, right? Get back. All right, so we went into the stock around $11, and here around August we got our $21. So this trade was in a matter of 2 months, something like this, 2 months, and we got our $10, about 100%. Of course, you can just use a couple of techniques for money management and get much more of it. I just want to remind you that back to the weekly chart, look, this stock went all the way from $10 to $53. This is just one instance. Let's look on couple more. Let's take, for example, PetX. PetX was issued, its offering day was 27th of June 2013. Right. Okay, and it was the offering and yesterday it closed for $22. That means 274%. Let's look how PetX is looking for us on the chart, and just referring to what Mina is writing in the chat room. We are not going to be part of the rich investors. We are not going to have our hands on the IPO in the underwriting price, but what I'm showing you here is how to trade it, after it's publicly trading. All right. So let's get back to the daily chart of PetX. All right, and I'm just going to zoom in. All right. Just going to zoom in. This is, all right, the end of June. This is the first candle of the IPO. Just look on the volume. Usually you are going to see a spike in the volume on the first day. This is the new birth of a new stock. So again, you are just sketching for us a buying order above the high of the first day, right? Look how it's chopping here a little bit, going sideways, and then around on the 5th day, it's breaking out, all right? And this is where we are in, around a little bit above $9. Again, my first target is going to be much higher than $9. It's going to be $10. I'm using $10 target, right? At least first target $10. I want to take the big money. So the stock is going sideways, and then around September, usually some big investors are discovering the stock. This is what's sending the stock up. And if we took it around $9, we need to get it to take it up to $19. This is where we get it around September. So we took it at the end of June. We waited for about 3 months, and we got $19. Again, something like 100% in a matter of 3 months. Let's go and see another example. For example, let's take, randomly speaking, let's take a stock. Let's take a stock I'm right now in, WBAI. All right, WBAI, and in a minute I want to show you how to recognize them, how to know which stocks are going to go public, which stocks are on the IPO schedule. So this is another example. This is the first day of WBAI, the 22nd of November 2013, not long ago, and this is the first bar. Again, usually the first bar is a wide range bar. This bar actually ended with a doji, a spike in the volume. Around 7 million stocks were traded in this day. I'm just going to draw for myself the high level of this day, and this is a buy stop. Usually you are going to use GTC, good till cancel order, all right? Because you don't know where the stock is going to break out. It may be one day after it may be 1 week after it, and as you can see, this stock actually break out 2 weeks after the first day of the IPO. So we took it around, let's say, $22. Our first target is $10. This is what I'm using. That means I want to get from $22 to $32, and I get $32 not long after. Actually, it took it about 1 week or 2 weeks of trading, and around here I got my first target of $10, and after that you can actually you can actually continue trading it on the last quarter or the second half, and just to raise your stop as the stocks is going higher and higher, and to enjoy all the travel up. All right, so this is about the technique. Tim is asking why $10 target. The $10 target actually is statistically proven. I made a research about these stocks, and I let the computer run all sorts of variations, and the $10 was on one hand a very, very large portion, a very, very large gain to take, and on the other hand, it was quite frequently. So quite frequently you are getting $10. So combined together, $10 is the best target to use. But you can use a technique a technique you are familiar with, something you are feeling good and right with. Now, of course, you can write questions as we continue with this webinar, and just a couple of minutes before we end this first part, when we actually focused on the swing trading, I want to show you how to know, and this is a good tool for the next webinar, how to know which companies are going to go on IPO, which companies are going to offer their stocks to the public. So I'm going. I just want to broaden my screen again, right? So we'll see my browser, and you can just copy the address. I'm going to use the address of the Nasdaq, the Nasdaq.com. All right. All right, so you can see right now my browser. So let's write here nasdaq.com. So the address is www.nasdaq.com/market/IPOs. Please make sure to put it in your favorites. I'm going to put it right now. Okay, I'm going to put it in the chat room. All right, and let's see what we have here. First of all, we have here a table of the latest IPOs. So can you see, by the way, can someone confirm that you can see my arrow? Can you see my arrow on the screen? Just tell me. You can see. All right. So this is the latest IPO. This is the left table. We can see here all the latest IPO. Let's say EGRX, FLXN, TLMR. All right. All the latest IPOs. For example, if I'm going, let's say we are looking on, let's say TLMR. TLMR was an IPO yesterday. All right. So this is TLMR. All right. This is all the chart we have. All right. Only one day. This is the second bar. I already have a stop buy above the high of yesterday's high, the yesterday's high, which is the highest point of the IPO, the IPO, which is $14. So right now it's around trading for $13.95, above $14. This is where I want to buy a TLMR and wait for $24. Wait for $10 to make the big money. On this trade. This is what we want to achieve. On the right-hand shoulder, we can see the upcoming IPOs. Here you can see all the IPOs that are going to offer the stocks in the upcoming month for February. For example, today is the 13th of February. We have 2 new IPOs, IBP, AMDA, and CNCE. Actually, you don't have to. You can visit this. Tables. You can visit the site every day on a daily basis. I'm doing it on a daily basis. You can do it once a week, but you don't want to miss anything. So just be sure right now to take all the latest IPOs, so you can have triggers on this trading style in the upcoming days, and of course get updated with the upcoming IPOs on the right table. All right, guys. So this is the webinar for today. Any questions? If you have any questions, this is a great time to ask. And if not, thank you very much for being with me for the last hour. I wish you best success with this trading style. I'm trading it very, very successfully for a couple of years now. Hopefully you are going to join me on the journey for being successful traders. And I'll see all of you in our next webinar next Thursday. All right, so I'll take questions right now. And let's see. Just have to Right. Let's see the questions. All right. How long do you swing trade IPO? Usually from a couple of weeks to couple of months, Rich. I have a special trading account that it's all focused on IPOs. This is a very, very profitable niche, and next week you are going to hear something amazing about why the investment banks that usually are trading against us, that you know, it's a zero-sum game in the stock exchange. So if we are profiting, someone is losing. So we are one of our enemies are the big investment houses, and you will understand why the IPOs is a very, very unique niche where the investment banks want you to profit. They don't want you to lose. They want you to be successful. We'll see it next week. All right, so this is for you, Rich. Mike is asking, how many IPOs are you losing on? Of course, Mike, there are IPOs that I'm losing, but just consider the statistics. All right, this is a very, very sound statistics, and the statistics tells us that 82% of the IPOs of the last 100 IPOs went up. They didn't went down. And when you give another test for the stock, you give a test for the stock to go above the high of the first day. So this gives you a much successful, a bigger successful rate, a larger successful rate, a higher successful rate. I should say, and but of course there are losers. So usually, if we are going back, by the way, let's get back to TLMR. All right, let's get back to TLMR to understand how to handle the risk. All right. All right, so I'm just broadcasting my screen again. So if we are watching TLMR, I'm going to place a protective stop, not below yesterday low, you can use yesterday low around 13.28 as a protective stop. I'm going to use the point below today's action, all right? Below around 13.60, this is where I'm going to put my stop. So this is about 40 cents on this stock, all right? But of course, there are losers. It's not just winners, but we have more winners than losers, and on average, every winner, when we are waiting for $10 profit, is much bigger than all the losers. All right, Thomas is writing. Thanks, Shlomo. Great seminar as always. Thank you, Thomas. Patty is telling us on your TLMR trade, where would you put your stop? All right, so I just answered that. Tim is writing, the IPOs, are they from all American exchanges or Nasdaq only? All right, great question. But I'll get back to I want to show you the table again. All right, so this is the Nasdaq site, but if we get into, for example, NRX, all right, so I'm going to click on NRX, and here you have a lot of information about the stock, like the company name, the company address, it's all right, the company address, the internet site, who is the CEO. It has this stock only, this company only 3 employees, and look that the exchange that is going to host this stock is the Nasdaq small cap market. But if there is an IPO, and if you will click on a couple of them, you will get it eventually. You'll see here also the other stock exchange, like the American Stock Exchange or the Nasdaq, the New York Stock Exchange. So all the American exchanges are listed here. All right. Tim is asking, when are you going to do the bottom fishing webinar, Shlomo? Tim, we have a long list of webinars ahead of us. This is one of the webinar about bottom fishing and actually falling knife. This is how I call this technique. Why don't we review the fate of IPOs in a bear market? Since 2009, we are in a bull one, so mostly everything goes up. All right, Garrick, this is true. This is true, but pay attention that during 2009 or 2008, during bearish markets, usually there are very little IPOs. And if we get back to this slide, right? If we're going to get back to this slide, look how IPOs we got on bearish years. On 2008, they were only 31 IPOs. 31 IPOs. We got to this number trading 1.5 months in 2014. So usually you are not going to have a lot of opportunities. Usually the IPOs that are going publicly in these years are very quality companies, and again, you have the trading technique that I just showed you. So you have a test. You have a test that the stock must qualify in order to be in your trading account. The stock must be trading higher above the highest level of the first day of the IPO. Okay, so this is for Allen. Kim is writing, in general, do IPOs make such a significant rise over time? When do you know it's stopping and out of momentum? So Tim, usually I'm just using the price action in order to understand it. If we'll take a look, for example, on WBAI, so this is a rising stock, and after taking around 32, 75% of my position, right now I'm with my last quarter, and I'm just using the higher lows. So this is a higher low. I'm putting my protective stop here. It's making a new high. All right, going a little bit of a pullback back to the 32s. I'm putting here another stop, another high. It's going back to the downside. Look that there is a higher low. I'm placing my stop here and here. So my stop right now is just above $35, and I'm just using the very, very classic trend, all right, This is what we are all, you're not seeing it. Oh, sorry about that. All right, so this is WBAI. All right, so this is where I took the first partial 75% around $32. We have here a higher low, a higher low, a higher low, a higher low. As long as I have higher lows, I'm just taking my stops up until I'm getting out of my last quarter. All right, so I'm just using the very, very classic tool of trend. You know, any trend, we designate a trend as at least 2 higher highs, 2 higher lows. This is what we see in WBAI. This is what we all see in other IPOs. This is how I'm using it. All right. Alan is writing, does the fact that IPOs going up has dropped from 80% last year to just over 50% so far this year? So actually, Alan, you know, we must have a depth for statistics to be considered, and if we are only 1.5 months in this year, and we only had 31 IPOs so far, not 100 IPOs. So we can't consider it as statistics, but even considering what we have right now, 21 out of 30, that gives you 70%, all right? So 21 out of 30, this is 70%. So it's not 50%, it's 70%. And I guess as we will have more IPOs, we will get back to around 80%. This is usually the long-term average. All right? Okay. All right, guys. Thank you very much. Hopefully this webinar is useful, and I'll see you all next week. Have fun with this technique, and of course, you can always write me emails to shlomo@tradenet.com. I'll be happy to answer you. Bye-bye all.